Meet Earl Crawley, a parking lot attendant from Baltimore, Maryland. At first glance, he appears to be just an ordinary nice guy, always ready and willing to help. However, upon closer inspection, you'll be surprised to learn that he's amassed a dividend stock portfolio worth $500,000. What's more impressive is that he achieved this with a meager salary of no more than $20,000 a year. So how did this unassuming man build his wealth on such a small income? The answer lies in his use of the power of dividend investing. In this video, we'll start by covering the basics of dividend investing, explaining what dividends are and how they work, and providing examples of companies that pay dividends. We'll then delve deeper into the topic through Earl Crawley's story and his investment strategy. Not only that, we'll be giving you tips on how to become a successful dividend investor. So, without further ado, let's jump into the topic. So what exactly are dividends? In short, dividends are payments made by a company to its shareholders, usually in the form of cash or additional shares of stock. They're typically paid out on a regular basis, such as quarterly or annually, and are determined by the company's board of directors. Some well-known companies that pay dividends include Coca-Cola, Procter & Gamble, and Johnson & Johnson. The amount of the dividend and its frequency can vary depending on the company's financial performance and dividend policy. One of the key advantages of investing in companies that pay dividends is the potential for higher returns and reduced volatility. Dividend-paying companies tend to be more stable and mature, with a track record of consistent earnings and cash flow. This can provide a cushion during market downturns and potentially lead to long-term growth in income. Take Coca-Cola, for example. The company's share has been traded in the stock market since 1919, and to this day, the company's stock performs exceptionally well. However, the primary reason for investing in dividend-paying companies, of course, is the dividend. By investing in dividend-paying companies, you can maximize your total return from both dividends and appreciation of the stock. But it doesn't end there. Instead of taking the money from the dividends, you can reinvest the profit and take advantage of the snowball effect. This is how Mr. Crawley and Warren Buffett make their fortune. In dividend investment, the snowball effect refers to the compounding of dividends over time, where the dividends received are reinvested back into the same stock, resulting in an increased number of shares owned. As the number of shares owned increases, the number of dividends received also increases, which in turn can be reinvested again to purchase even more shares. This cycle continues and can lead to exponential growth of both the number of shares owned and the amount of dividends received, creating a snowball effect. For example, let's say you bought 10 shares of Coca-Cola stock at a price of $50 per share for a total investment of $500. Coca-Cola currently pays an annual dividend of $1.68 per share, which comes out to a dividend yield of 3.4%. If you reinvested your dividends and Coca-Cola stock continued to increase its dividend payout by 5% per year, your investment would grow significantly over time. After 10 years, assuming no change in the stock price, you would have accumulated 14.32 shares and would be earning an annual dividend of $24.07. After 20 years, you would have accumulated 22.58 shares and would be earning an annual dividend of $37.99. It's worth noting that not every company is giving dividends to its shareholders. Usually, it's only mature companies that pay dividends, and there are certain metrics that you need to know before investing in a company. First, dividend yield. This is the dividend amount expressed as a percentage of the stock price. It's a measure of how much income you can expect to receive relative to the price you pay for the stock. Second, dividend payout ratio. This is the percentage of earnings that a company pays out in dividends to its shareholders. A high payout ratio may indicate that the company is not reinvesting enough of its profits into the business for future growth. Third, dividend growth. Look for companies with a history of increasing their dividend payouts over time. Consistent dividend growth can be a sign of a healthy, growing company. Fourth, earnings per share. This is the amount of earnings per share of stock. Ideally, you want to see a company with a high EPS, as it indicates that the company is profitable and may have the ability to continue paying dividends in the future. Fifth, price to earnings ratio. This is the ratio of a company's stock price to its earnings per share. A lower PE ratio may indicate that the stock is undervalued and have the potential for future growth. However, a high PE ratio may indicate that the stock is overvalued. And sixth, financial health. Consider a company's financial health, including its debt levels, cash flow, and profitability. A financially healthy company is more likely to continue paying dividends over the long term. There are various ways to invest in a dividend-paying company. The obvious way is to buy the stocks of a company that consistently pays a dividend. Some of these companies are Johnson & Johnson, Procter & Gamble, Coca-Cola, ExxonMobil, and IBM. However, instead of buying the stocks individually, you can also invest in a company that pays dividends through mutual funds and ETFs. Mutual funds are investment vehicles that pool money from multiple investors to buy a diversified portfolio of stocks, bonds, or other assets. In the context of dividend investing, mutual funds may invest in dividend-paying stocks and distribute those dividends to shareholders in the fund. This can provide investors with a more diversified portfolio of dividend stocks than buying individual stocks themselves. Exchange-traded funds, or ETFs, on the other hand, are similar to mutual funds, but they trade like stocks on an exchange. Like mutual funds, ETFs can provide investors with exposure to a diversified portfolio of dividend-paying stocks. ETFs also typically have lower management fees than mutual funds. Additionally, ETFs can be bought and sold throughout the trading day, like stocks, providing investors with more flexibility and control over their investments. Some of the best ETFs in the high dividend yield category are Vanguard High Dividend Yield ETF, Schwab US Dividend Equity ETF, and Investco S&P 500 High Dividend Low Volatility ETF. However, investing in dividend-paying stock is not only about reading a company's financial statements and choosing the best stock. It's more about attitude, and we can learn this through Earl Crawley's story. Earl Crawley is a true inspiration when it comes to personal finance. Despite working as a parking lot attendant for 44 years and earning no more than $20,000 per year, he managed to accumulate a dividend portfolio worth $500,000. Earl started working at the age of 13 and faced many challenges due to his dyslexia, which limited his job opportunities. However, he was determined to overcome these challenges by living within his means, keeping costs low, and investing regularly. Earl started by purchasing savings stamps and savings bonds, and later graduated from investing in a mutual fund. He consistently invested $25 per month for 15 years, and by the late 1970s, his net worth had reached $25,000. In 1981, he started investing directly in blue-chip dividend-paying stocks, like IBM, Coca-Cola, and Caterpillar. He kept reinvesting his dividends, which increased his shares in dividend income. He said, "Just let your money work hard for you instead of the other way around." Earl learned about bonds, dividend reinvestment plans, and investing in the stock market by asking questions and picking the brains of anyone who was engaged. And by 2008, Earl had a portfolio worth $500,000, a fully paid-off house, and no debt. His story provides several valuable lessons, such as living within means, saving regularly, and investing consistently. These are all needed for successful investment. Other things that are needed for successful investing are patience. Investing is a long-term game, and it can take time for your investments to grow. It's important to have patience and avoid making impulsive decisions. Discipline. Having discipline means sticking to a plan and avoiding emotional decisions that could hurt your portfolio. It's essential to have a strategy and stick to it. And long-term thinking. Investing is about looking toward the future and making decisions that will benefit you in the long run. It's important to have a long-term perspective and not get caught up in the short-term fluctuations. Overall, Earl's consistent investments and reinvestment of dividends allowed him to steadily grow his portfolio, eventually leading to his financial freedom. He now pays it forward by teaching others about the power of dividend reinvestment and compounding. We encourage you to follow in Earl's footsteps and begin your own dividend investing journey if you haven't already. With discipline, patience, and a willingness to learn, anyone can achieve financial freedom through the stock market. Remember, dividend investing is a powerful tool for building wealth and achieving financial freedom over the long term. By investing in quality dividend-paying companies and reinvesting those dividends, you too can take advantage of the power of compounding and grow your wealth over time. Thank you for watching. If you're interested in learning more about personal finance and investing, make sure to subscribe to our channel for more informative videos. Don't forget to hit the subscribe button so you never miss an update. And remember, investing in your financial future is one of the best decisions you can make. Start your journey today by taking action and implementing what you've learned. See you in the next video.